This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 30, 2026, and this is the Tokyo session. Now, let's get into it. The U.S. economy just stumbled. Second quarter growth was revised down to 1.5%, missing estimates of 2.1%, while core inflation is stuck at 3.4%, still well above the Federal Reserve's 2% target. In this environment of slowing growth and sticky prices, the dollar is facing a perfect storm of headwinds. But there is a wild card. The Bank of Japan is about to make its rate decision. With the fear and greed index at a fearful 14, and positioning in the yen wildly one-sided, we're looking at a session that could violently reprice risk. Let's find out where the money is going. Before we dive into the charts, let's look at the calendar. The single most important event today is the Bank of Japan's rate decision. It drops at 3 o'clock in the morning Eastern Time. This is the key catalyst for the yen and global carry trades. If the BOJ signals further tightening, it will force a re-rating of the entire carry trade structure. Also on the docket, though less immediately volatile, is the European Central Bank decision on Thursday, August the 6th. But that's a week away. For now, the market is digesting today's U.S. data, Q2 GDP, jobless claims, and PCE, and waiting for the BOJ. Apex, what's the risk here?
The risk is that the market underprices the BOJ. Everyone is focused on the US GDP miss, but the yen's positioning is so stretched that any hint of hawkishness from Tokyo could trigger a squeeze on shorts that has nothing to do with the Fed.
Here is where we stand in the New York session. The dollar is mixed. The euro-dollar is down 1.5% at 1.1450. Cable is lower by 0.16% at 1.3345. The Aussie is down 0.10% at 0.6952. On the safe haven side, gold is trading at $4,059, down 0.6%. The dollar-yen is up 1.2% at 163.50, and the dollar-Swiss franc is up 0.2% at 0.8155. The VIX, which measures equity volatility, closed yesterday at 18.21, showing a slight dip in fear from the previous session. But the broader sentiment index is at 14, deeply fearful territory. Let's talk about the headlines moving this data. First, we have the U.S. Q2 advanced GDP coming in at 1.5% versus an expected 2.1%. That is a significant miss. That miss changes the narrative. The market was pricing in a soft landing, but 1.5% is stagnation. Combined with core PCE inflation at 3.41% and still above target, the Fed is in a bind. They can't cut easily because inflation is sticky, but they can't hold rates higher for long because growth is fading. Second headline, WH advisor Hassett says inflation is continuing to ease. That's the bull case for the dollar selling. If inflation is easing, the real yields should compress. But wait, core PCE is still 3.41%. The narrative is shifting from inflation is winning to growth is losing. That favors safe havens like gold and potentially the euro if the Fed is forced to pivot. Third headline, U.S. initial jobless claims came in at 197,000, beating the expectation of 200,000.
That's a better-than-expected labor report, but in the context of the GDP miss, it suggests the labor market is cooling, not overheating. It doesn't save the dollar, it just confirms the slowdown.
And finally, the BOJ rate decision is looming.
Nobody is talking about the positioning risk here. Leveraged funds are strongly bullish on the yen, with a net long position that has surged by nearly 100,000 contracts week over week. This is a crowded trade. If the BOJ stays dovish, the trade unwinds violently to the upside.
Let's start with our top priority, dollar-yen. The BOJ decision is live. The yen is trading at 163.50, up 1.2% on the day. Grid, what is the structure?
The structure is tight. Over the last 5 days, dollar-yen has traded between a low of 163.213 and a high of 163.951. We are currently sitting right in the middle of that range at 163.50. It's a classic consolidation box. The price action is choppy with no clear breakout yet. The volume isn't confirming a directional move yet, which means we're waiting for the catalyst.
And the positioning is screaming for a move. CFTC data from last week shows leveraged funds are strongly bullish on the yen, with a net long position that increased by 97,394 contracts in a single week. That is a massive surge. Asset managers are also net long, though less aggressively. This is a crowded long position. When you have this much skew, a neutral BOJ statement doesn't just hold the line, it triggers a squeeze.
But wait, look at the macro. The BOJ is likely holding rates steady or moving very slowly. The US 2-year yield is at 4.26%, while the BOJ yield is near zero. The yield differential is massive. Why would the yen strengthen fundamentally? It wouldn't unless there's a fear of intervention. The BOJ has threatened intervention when the yen gets too strong. If they stay neutral, the yield gap keeps the dollar bid up.
Pulse, you're ignoring the technicals. The price is already up 1.2% today. If the BOJ had signaled hawkishness, we would have seen a bigger move. The fact that we're consolidating in this narrow 163.213 to 163.951 range suggests the market is pricing in a no-change outcome. The squeeze might be delayed, not denied.
I'm worried about the trap. The consensus is dollar strength continues because of yields. But look at the fear and greed index at 14. In extreme fear, correlations break down. If risk assets start to wobble later this week, traders will dump the dollar-yen carry trade regardless of the yield curve. The crowded long yen position is a liability, not an asset in a stress scenario.
Moving to euro-dollar. It's trading at 1.1450, down 1.5%. The euro has been under pressure, but the US GDP miss is the story. Grid, what are we seeing on the chart?
The euro-dollar has been trading between 1.13533 as the 5-day low and 1.14752 as the 5-day high. Currently at 1.1450, it's holding just below the upper band of that range. The structure is range-bound. It bounced off the 1.135 level earlier in the week and has been consolidating since. There's no momentum here. It's a dead market until the BOJ decision provides a direction for the dollar.
Let's look at the flows. CFTC data shows leveraged funds are strongly bullish on the euro, with a net long position of 1,209 contracts, and they added 1,363 contracts week over week. Asset managers, however, are net short, with a position of negative 3,290 contracts. So you have hedge funds betting on a euro recovery, but asset managers, long-term capital, are still shorting it. This divergence suggests the current move is speculative, not structural.
The macro supports the hedge funds. The US GDP is 1.5%. The Fed funds rate is 3.63%. If the Fed is forced to pause or cut due to growth concerns, the dollar weakens. The core PECE is sticky at 3.41%, but the market is looking forward. If they see inflation easing, the real rate differential narrows. That helps the euro.
But look at the risk. The VIX closed at 18.21 yesterday. It's not high, but it's not crashing. The bigger risk is that the US data is weak, but the ECB is also facing growth issues. Germany's preliminary CPI is at 2.8%, which is low, but the BOE is holding rates unchanged with Governor Bailey warning about second-round effects. There's no clear, stronger economy narrative for the Eurozone. The Euro's rally might be a dead cat bounce off the 1.135 support.
I agree with SPECTER on the lack of conviction. The 1.14752 high from Monday hasn't been challenged strongly. The price action is hesitant. Until we see a close above 1.14752 with volume, this is just noise. The support at 1.13533 is the real floor. If that breaks, we're looking at lower levels.
Let's talk about gold. It's at 4,059, down 0.6%. It's a safe haven play in a fearful market. Grid, what's the setup?
Gold has been volatile. The 5-day range is 3,995.98 to 4,116.61. Today it's trading at 4,059, which is in the lower third of that range. It tested the low of 3,995 on Wednesday and bounced. The structure is a descending triangle on the hourly, but on the daily, it's holding above the psychological level of 4,000.
The positioning is fascinating here. CFTC data shows leveraged funds are strongly bearish on gold, with a net short position of negative 540 contracts. They've held this short position steady, but asset managers are net long with a position of 0, which means they are flat or just entering. The key is that despite the bearish hedge fund positioning, the price is holding. That's a classic divergence. When smart money is short but price holds, it usually means the short squeeze is coming.
The macro is gold's best friend right now. The fear and greed index is at 14. In extreme fear, capital flees to gold. The U.S. real yield is compressing because growth is slowing. The 2-year, 10-year yield curve is at 0.45%, which is flat. A flat curve often precedes rate cuts, which is bullish for gold.
But don't get complacent. The CFTC data shows the leveraged funds are net short. They are the ones who get margin called in a crash. If the dollar strengthens unexpectedly on BOJ news, gold could see a sharp, liquidation-driven drop below 4,000. The bearish positioning is a lagging indicator. If the trend reverses, those shorts will pile into the same direction, accelerating the move down.
Finally, cable. Cable is at 1.33456, down 0.16%. The BOE held rates unchanged. Grid, what's the chart saying?
The 5-day range for cable is 1.32734 to 1.33875. We're currently at 1.33456, which is right in the middle of that range. The price action is tight. It rallied to 1.33875 on Monday and has been consolidating since. The structure is neutral, no clear breakout or breakdown.
The CFTC data shows leveraged funds are neutral on the pound, with a net position of negative 154 contracts, and they reduced their net short by 33,390 contracts week over week. That is a massive unwinding of shorts. Asset managers are net long, with a position of positive 16,284 contracts. So, the speculative shorts are covering, and long-term capital is holding. This suggests the downside is limited.
The BOE is hawkish relative to the Fed. Governor Bailey warned about second-round effects in inflation. The UK inflation environment is sticky, while the US is slowing. This policy divergence supports the pound. The 1.32734 low is a strong floor. As long as the BOE doesn't signal cuts, the pound has a bid.
But the US dollar is weakening across the board. The dollar-yen is up, but the dollar-euro is down. The dollar is getting caught in the crossfire. If the US data continues to disappoint, the pound could see a technical breakout above 1.33875. The risk is that the BOE is behind the curve on inflation. If UK inflation spikes, they might have to hike, which would support the pound further, but if they don't, the pound could fade.
I'm watching the 1.33875 level. If we break that, the next resistance is higher, but for now, it's a range.
Let's tie it all together. Apex, what's the strategic view?
The common thread is US data weakness. The GDP miss, the jobless claims beat, and the sticky inflation create a narrative of stagflation fears. This favors safe havens like gold and the yen, but also the euro if the dollar weakens. Grid flagged the tight consolidation in dollar-yen, but CIPHER highlighted the massive short squeeze risk in the yen due to crowded positioning. SPECTER warned about the trap in gold, despite bearish positioning. Pulse noted the macro divergence favoring the pound and euro. My read, the BOJ decision is the key. If they stay neutral, the yen squeeze is delayed and the dollar remains range-bound. If they turn hawkish, the yen surges and the dollar sells off sharply. For gold, the fear regime supports it, but the bearish positioning is a risk. For the euro, the technicals are range-bound, but the macro supports a move toward the 5-day high.
To recap, the U.S. economy is slowing, with Q2 GDP at 1.5%. The BOJ rate decision is the wild card for the yen. Gold is holding despite bearish positioning, supported by extreme fear. The euro and pound are range-bound but supported by U.S. weakness. Watch the BOJ decision for direction. The macro setup favors a weaker dollar if the Fed is forced to pause. With the 2-year, 10-year yield curve flat and GDP missing estimates, the case for rate cuts is strengthening. My weekly call, euro-dollar bullish, target 1.1550 by Friday.
The euro-dollar is holding the upper end of its range. If it breaks 1.14752, it could run, but the volume is low. My weekly call, euro-dollar neutrals target 1.1420 by Friday.
The positioning in the euro is shifting. Hedge funds are adding longs, and asset managers are covering shorts. This suggests underlying strength. My weekly call, euro-dollar bullish, target 1.1500 by Friday.
The yen squeeze is the biggest risk. If the BOJ turns hawkish, the dollar will crash. But if it doesn't, the dollar might grind higher. I'm worried about a dead cat bounce in gold. My weekly call, gold bearish, target 3,980 by Friday.
The BOJ decision is the key. If they stay neutral, the yen squeeze is delayed. The dollar remains range-bound. My weekly call, dollar-yen bullish, target 165.00 by Friday.
If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Forex trading carries significant risk of loss. Always do your own research before making any trading decisions. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.